So welcome all to the Shah Distinguished Lecture. I'm Jack Baker. I'm going to do the introduction here. I'm on the faculty in Civil and Environmental Engineering, for those of you I haven't had a chance to meet. Maybe I'll start by saying thank you to all of you. This is like the best behaved audience. Everybody's in their seat early. It's like 4:30 on the dot and we're ready to go. So yeah, you must be excited for the event here this afternoon. I know I am. So I'll just share a few remarks before turning over the stage to our speaker. So as I said, this is the Shah Family Distinguished Lecture. You can see a title and speaker's name. I'll come back to that in a moment. But first, I think there's a number of students here this is their first year at Stanford. And so I wanted to make a few remarks about the Shah Family Fund. So Stanford is fortunate to have this fund that was generously given by the Shah family. So Haresh, who's in the front row as well, for those of you who hadn't had a chance to say hi or introduce yourself, say hello afterwards if you can. And his family gave this generous gift to the university a number of years ago, and it funds a lot of really exciting things here. So the most presently notable is this distinguished lecture. So we have the opportunity to bring in people from around the country and really around the world to speak on topics related to catastrophe risk. And it really creates gives us this opportunity to engage with experts in the world and have these times where we can think about bigger issues in our field. It also funds a great number of student fellowships. I'm certain there's a number of people in the room who are funded by or have previously been funded by the fellowships to support research students working in catastrophic risk. It also funds kind of the premier staff award in the department in the School of Engineering. So a number of activities and recognitions that are made possible by this fund. So that's very exciting. And then this is the photo that I've been seeing since when I was a student here. This is Haresh a few years previously. So a few additional notes. So Haresh was a professor in our department for many years, chair of the department for many years, and led a lot of exciting initiatives and brought a lot of resources into the department that's really enabled many of the things that continue to this day. And I wasn't fortunate to be a faculty member when he was here, but knowing him since then and hearing the stories, I think his energy was a notable characteristic. This is a post-1989 Loma Prieta. I've spoken to a number of faculty members and neighbors who had their houses personally inspected by Haresh after the earthquake, and he snapped to it, kind of running around the campus and kind of seeing where we were at and helping the campus kind of assess the situation and get back on its feet. And I think that's kind of one example of many ways in which his energy and what was devoted here, but his vision for kind of the role of catastrophic risk analysis in the academic work we do here, I think has really set the stage for a number of initiatives and activities that have taken place in the decades since. So I think we're tremendously grateful for that vision and as well as the resources that make these types of events possible. It's really a great thing about this program and university. So then to start transitioning, let me say a few words about our speaker this afternoon. So I'm pleased to welcome Professor Howard Kunreuther to speak this afternoon. So I'll note a couple of biographical things. He's the James G. Dinnan Professor Emeritus of Operations, Information, and Decisions at the Wharton School in University of Pennsylvania. And he's also the co-director of the Wharton Risk Management and Decision Process Center. This is a large research center that's working on issues related to risk, and he'll certainly tell you more details about that as he gets up here. I thought, for me, I've known of Howard's work for a number of years. I've met him a couple times briefly in the past. But for me, and for at least for me personally, and I think my colleagues kind of saw the same when we thought about inviting Howard, I kind of know him through a set of books. So it's appropriate that you have one in front of you. That wasn't my idea. It was his idea. But I know him a lot through these books, and I thought I would maybe mention that by way of introduction because he has a lot of academic accolades and things that some are listed in the bio and some you could find on his website. But I think these books are really an interesting thing, and an interesting way to kind of understand his work. So I first got to know him from this book, Catastrophe Modeling, A New Approach to Managing Risk. This is a 2005 book, so things have matured since then, but it was really one of the first exposures to kind of what's going on in catastrophe risk modeling. There was kind of public domain. There was experts in this area, certainly, but it was hard as a young scholar to kind of understand these things. And Howard, together with his co-author Patricia Gossi, compiled this book to really document kind of what the process was, to look at some benchmarking. I note Wei-Min Dong, who's in the audience, wrote one of the chapters in this book as well. There was a number of experts kind of from that field. And I still loan this book to all my PhD students as a way to understand this. So I think really kind of a great contribution that's held up over 15 years documenting that. Moving more broadly, there's managing catastrophe risk. This is a book looking at kind of corporate risk management and really in-depth interviews with managers in large corporations and how do they really understand risk, deal with risk, manage risk. So looking more from kind of the business side and the organizational side. And then the ostrich paradox, which you have in front of you, looking at kind of behavioral economics and kind of how these issues permeate decision-making under low probability, high consequence events. And so I noted, it's written in the bio that you have, but I also noted on his website, he has an interest in the ways that society can better manage low probability, high consequence events related to technological and natural hazards. I thought that's a great kind of summary, and I thought I would just flash these books at you to show kind of the breadth of ways in which that can be done, right? So the umbrella of how does society manage these low probability, high consequence events? You can come at that from a very engineering technical perspective. You can come at it from an organizational perspective. You can come at it from a psychological perspective, and all those perspectives are really needed. And I think Professor Kunreuther is one of the people who really weaves those things together in his scholarship in really interesting ways. And I could note, he has additional scholarship on, the role of public-private partnerships in these issues. He's worked with the IPCC on looking at, risk from climate change. He's looked at the National Flood Insurance Program. So a great number of ways in which he's engaged. But I just thought these books were kind of an interesting way to look at the way he's transmitted that scholarship, both in academic circles and to broader audiences. So I think more interesting will be to hear from him directly. So at this point, I will turn the stage over to Howard and say thank you very much for coming this afternoon. We're looking forward to hearing from you. Here.
Well, thank you very much, Jack, for that warm and kind introduction. And in answer to your question of managing low probability, high consequence events, how we do it, we don't do it very well. And there we have our challenges in dealing with this. But I want to start my little presentation here with, and this is a real honor for me to be here because of the fact that this is a Shah symposium, seminar, talk. And I wanted to give a little bit of background on how I not only was honored by having an opportunity to interact with Haresh, but how he set the stage for a good deal of the work that we have been doing in this whole area of catastrophic risk. I met Haresh Shah a number of years ago when he was giving lectures at Penn, and we were both together there. But my first real formal meeting with him was in 1995. And in 1995, I came out, the economic meetings were in San Francisco, and Haresh had said to me, look, you've got to come out and go to Risk Management Solutions and see some of the things that we were doing. And as you all know, he founded Risk Management Solutions. And so I came out there in early January, and everyone in Risk Management Solutions was there. And Haresh and I started talking about the work that we were doing at Penn, we had formed a Wharton Risk Management Decision Process Risk Center about 10 years before, and as Jack indicated, we were focusing on low probability, high consequence events, and Penn had made an offer to all centers at that time that if they could put something together for the 50th anniversary of the ENIAC computer that was started at Penn, we should actually suggest something. And so I mentioned this to Haresh. I said, we would like to maybe do something on things that we've been interested in, catastrophic risk, and I know you have this incredible modeling company that you're doing these things. Would you have some interest in getting involved? Now, if you know Haresh, you know he's an entrepreneur of the highest order, and he is a generous entrepreneur. And the first thing he said to me, he says, I think that's a really good idea. I'll support it. And I didn't know quite what he meant. We said, let's bring the three modeling companies together. Let's bring our Risk Management Solutions, Equicat, and ARR, we're ARR worldwide. Let's get the best seismologists who are involved in this issue. Let's get the insurers and reinsurers. And the whole conference took shape in his office. And as a result of that particular discussion, we did have this symposium that year, and it started the project that you're referring to with this book of Mastering Catastrophic Risk that was done with the 3 modeling companies, and it really, and with the insurance industry, and with the best scientists on both earthquake as well as we were working with flood and hurricane, and really set the tone for a great deal of the work that we have been doing ever since with the Wharton Risk Center on other issues as well. But I want to thank you personally, Haresh, and I can't tell you how delighted I am to see you after a number of years for what you have done for not just myself, but for a whole group of people who were associated with the activity. And I appreciated your mentioning this book, which was done with a doctoral student of mine, Patricia Grassi, who went to Risk Management Solutions afterwards. And it really sets the tone for the things I want to talk about today. So let me see if this thing is working. Well, let's go in the right direction. Whoops. Here we are. So what I want to do today is to talk a bit about the challenges of how reducing losses from catastrophic risk and the role of the behavioral risk audit, which I'll mention in a few minutes. I should just tell you just briefly, those of you who don't know me, my own background, I am trained as an economist. I have often been called an irrational economist. I can say now a behavioral economist, working with psychologists and geographers, but working with the risk community in the spirit of what Jack was mentioning and that I just talked about in the context of catastrophic risk. And our interest has been always in understanding the decision-making processes of individuals, of organizations, of governments, and then more recently, since we've been working with climate change and a number of these issues in terrorism, the challenges we face around the world. And what I want to talk about today is really some of why we are in a new era of catastrophe, and let me give you a little outline of where I'm going. Then develop a conceptual framework for studying risk that I tend to use in courses that I've taught until just this past winter, this past year, on risk analysis and environmental management that brings together risk assessment, risk perception, and then risk management, and then end with some challenges and questions for discussion, and open it up, and I hope we can have a dialogue on these issues with all of you. So how am I going to start? Well, I always wondered, what's the best way to begin? And I have to begin with a personal photo that I took when my wife, Gail, and I were in Leeds Castle about a year and a half ago, and we came to this lake. We see all of these black swans. And those of you who know the book by Nicholas Taleb, The Black Swan, he writes about low probability, high consequence events and says we have very few black swans. And here I saw a number of them that had all been imported from when they were redesigning the castle from Australia. And I said, well, this is the world we're living in right now. There are a lot more black swans than before, so I figured I could show you an actual photo of many black swans that are around, and then highlight the fact that if you start looking at what's happened to the world between 1970 and 2018 and 2019 would be added onto that, you can see that things have just changed in the direction that actually suggests we have real challenges in terms of how to deal with them. And here are the dialogue on the insured and uninsured losses. And so you can see we have a major problem with respect to the fact that things are going to get worse. And here, one more slide where you can see a number of the disasters that have occurred, including ones here in California, like the Camp Fire, that I will say a word about wildfires in a moment, and a number of the hurricanes and earthquakes and things of that nature that we are faced with. So we have a problem in the following sense. Things are getting worse, and it's hard to see how we're going to actually reduce these risks over time, but we at least know that we have a challenge. And I will say that when we started our center, there were relatively few people who were concerned about issues of catastrophic risk, and even the forerunners in terms of the modeling companies, others were working on this, but now it's center stage on the agenda. As Jack was mentioning, when we did this book on mastering catastrophic risk, we interviewed 100 of the chief risk officers and CEOs of the S&P 500 companies, and every one of them, maybe there was one who didn't, said this is top of our agenda now in dealing with this, and the board of directors and others are really concerned about these issues. And so we are now putting more emphasis on that. So I want to talk about two problems that are faced here in California that all of you know about, and we're working on both of these problems. The wildfire problem is a major problem, and in fact, we're doing more. I'll be tomorrow spending time with a number of people on the wildfire issue, because it really does raise enormous challenges, not only for California, but for other parts of the world, but raises the broader issue of what these losses have been. And as you can see, there's $565 billion in damage in California the last 3 years. Camp Fire itself, which I mentioned a moment ago, destroyed 18,800 structures when that occurred. And the real challenge, and this is what this theme of this talk is about, is that many homeowners in the high-risk areas have not invested in loss reduction measures and mitigation measures. And the challenge we're faced with is, how do we get them to do this and in a way that they will not only want to do, but that we know is going to be an important thing for a broader audience. The insurers have increased their premiums and stopped offering new coverage. And then you had Pacific Gas and Electric, as many of you know, shutting off power in many areas, having to do with the challenges of inverse condemnation and things I'm not going to get into here. But there are a whole set of issues on wildfires that we really have to pay attention to. I won't be going into detail on that today. What I want to focus on primarily today, and I think it's appropriate to focus on that, given the group that I'm speaking to here, many of the people here, faculty and students from civil and engineering, is the earthquake problem in California. And here again, we have essentially the same kind of challenge, that most homeowners in these areas do not voluntarily purchase earthquake insurance. It's not required, and they only buy it, and this is, of course, the challenge we face. They buy it after an earthquake occurs, not before. And that's not exactly the time to buy insurance, as we all know, but that's when they tend to say, well, I better have this. And following the Northridge earthquake, 2/3 of the homeowners in Cupertino County had purchased this insurance, and then the private insurers refused to offer earthquake insurance after 1995, and we have a very effective organization that is very concerned, and I know there are representatives here today from the California Earthquake Authority that is concerned with that, and that actually dealt with that. And so, the other part of it, this is the other part, but it's a part of the challenge we face. Those who do not experience earthquake after a few years, so they bought insurance after an earthquake, after Northridge, and then after a few years, they haven't had a loss. And so what they say is, look at this, I put all this money into premiums, and I haven't gotten anything back. This is not a good investment. And they cancel their policy. And right now, you have a very, very small percentage, about 13% of the people in California have earthquake insurance, where over 2/3 had it in these areas. And it's one of the hardest things to do is to convince people that the best return on an insurance policy is no return at all. Celebrate you haven't had a loss, and go out and have a dinner. We're suggesting give people a chit. The insurance should say, we'll give you a chit to go to dinner and celebrate, but please continue your coverage of earthquake insurance. That's the deal. Celebrate, have a dinner, and then have it again. So this is a real challenge, and in fact, in our risk management solutions estimate, an RMS estimate would be that if you have 7.9 quake in the Bay Area, the damage could be about $200 billion in terms of losses. So this is the challenge, and I'm going to focus on this as an example as we go through, but this could be applied to a whole set of other problems. We've done a lot of work on the flood problem. I'll mention a little bit about that, but it could be applied to wildfire and others with various modifications in terms of how we would look at the problem. But what I want to do to start with is to start with a conceptual framework for dealing with risk. And I should say right at the outset, there are many different conceptual frameworks one can use when you deal with any problem. This is a conceptual framework that I have used in dealing with a course that I've taught over the last few years on risk analysis and environmental management. And what it does is, it sort of says, look, you got to start somewhere, and the place to start, and certainly with this audience, I don't think there'll be a problem in people agreeing on this, is risk assessment and vulnerability analysis. If we don't understand what the risk is, if we don't understand how to characterize the risk, it's going to be very, very difficult to manage that. So what you want to do is you want to model what the risk is. You want to have the engineers and the scientists and whatnot build scenarios and data building and whatnot, and recognize essentially that this is really step number one in looking at any particular problem in terms of at least trying to figure out how to manage that problem. And that is the kind of thing that, at least when we look at particular projects that students might be doing, and we deal with current risks in the class, every year it'll be a different set of risks, if they can't necessarily talk about what the uncertainties are, what the assessment is, it's going to be really hard to move forward. But here's where I may differ from from others, perhaps, but hopefully we're all on the same wavelength, and hopefully you will be that at the end of the day, is the perception is as important. If you know what the risk is, but how do the various stakeholders, the interested parties, actually perceive the risk? The public perceptions are often going to be very different from the experts and how they look at it. And you'll find your favorite expert to defend your position. And the real challenge is, and we'll talk a little bit about that in a few minutes, is how do you communicate this risk? So if you're going to be dealing with the assessment side and you say, look, everyone is making a mistake, they really, really are not assessing the risk correctly, you're really missing the boat in terms of the fact that maybe there are a lot of reasons that they don't perceive it the way you would like them to. And my colleague here, Ralph Keeney, who's here with us, has talked about the values that people will have, the way that they actually may see the world differently, and as a result of this, how they actually address the issue perhaps in a different way and see it in a different way. And I'll get into more detail on that in a few minutes when I talk a little bit about ways to address that. And then you've got these two things on the table, and then the framework that we would suggest, a way of looking at it is, what kind of strategies can you use that people will be adopted? And I would say one of the big changes in our own risk center, we've always thought about policies from day one. That was something, as an economist, I have to think about policies. That's where you come from. How do you actually deal with it? But the real challenge is implementing those policies. How do you figure out a way to develop policies that people will actually implement? And there are a whole set of policies that one can think about. I'll just put a few of them on the table, and there's a lot of white space here for you to add other policies that are not here. How do you provide information and communicate it? What kind of incentives, good or bad, subsidies or fines? Regulation, standards that are well-enforced standards. You can set a standard. If they're not well-enforced, it's a challenge. Compensation, insurance, and of course, we have our lawyers. The liability system is an important component as well, so, and particularly here in the U.S. You got all these things, and here's the way I'd like to pose it for you to reflect on, and that is, how do you evaluate these strategies? Now, what economists have normally done, and I've done this myself, I can't say I'm not one of those people, you say, what's going to be the impact on society, the efficiency of these things, how do you allocate resources efficiently? But there is another part of that, and that's the whole equity issue. How are different parties going to behave? How is the real estate industry going to look at a particular policy? What about banking? What about the homeowners seeing it different from essentially the firms that are dealing with it? The whole set of things that play a role here. And so put on the table these things. So that's the framework. That's the kind of thing that at least one can think about in terms of dealing with it. And let me say a few words about each of these things right now. Raise a few questions. How do you link the tools of risk assessment and our knowledge of risk perception to develop risk management options that are likely to be successfully implemented? What is the changing role of the public and private sectors? And boy, we're dealing in a world today that we all know things are changing rapidly as we speak here in terms of what role government is going to play, what role the state, federal, and local here in the U.S. and around the world government, and what the private sector will play. And how can we utilize the lessons that learn from past events and helping to plan for the future and deal with that. Okay, let's talk about risk assessment for just a few minutes. Risk assessment, which is what I've spent a good part of the day with a great group of people here at Stanford, students as well as faculty, talking about that. And that's really the expertise that many of you around the room have, and we don't have that at our risk center. We have to rely on other people when we were dealing with this with respect to that. But what it means is, risk assessment, a way to pose it is, it encompasses the estimate of the likelihood of events occurring and their potential consequences. We do know, and you do know, I think from your own research, experts are going to differ on their estimates of the risk. That's why you can find your favorite expert to support your position. You'll find someone, including climate change, as we know. You'll find a climate denier who has some kind of respectability in terms of a title, and you can see where my position is right now. As Jack said, I spent 4 years with the Intergovernmental Panel on Climate Change, looking at policy options, and this is an issue we do have to pay attention. But people who don't like it can find someone, who's dealing with that. Let me just go back. So that's kind of the challenge here. Now, the other aspect of this is what's composed. Well, there's vulnerability analysis. How do we look at the physical, social, political, economic, cultural, and psychological harms to which individuals in modern societies are susceptible? And the minute you bring in some of these other factors like psychological harms, you're sort of expanding over the normal issue of risk assessment, which focuses often on probability and consequences. But if people don't sleep well at night and they're concerned about that and want peace of mind, they may do certain things that you say, well, they shouldn't be doing that, but they do it for a lot of reasons. And we've already know how to reduce it. And then the one point that I'd want to highlight that we have found very useful in our own research, and I think some of you may as well, idea of constructing scenarios is really important because it gives you some notion of what's the likelihood of a scenario, a worst-case scenario, what is the likelihood of that occurring, what are the consequences, scenarios that are not quite so bad, but putting them on the table and having people think about those things may be a way to at least address this problem. So these are the features essentially with the risk assessment. And I have to put this up. My God, this is something I got right from Risk Management Solutions, because an exceedance probability curve, I would never have seen one of these things unless we were working with all the modeling companies use this. And this, I think, is a very valuable way. Don't look at the curves as a, let me see if I can do this. I think I can. Here we go. But the notion is you have some element on the x-axis. It could be loss, it could be number of lives lost, it could be environmental harms. I just put loss down here to illustrate this. And then you have essentially what's the likelihood the losses will exceed a certain magnitude. And what it does is it gives you some basis for being able to estimate this, but there's a mean estimate, but you can have confidence intervals around that estimate, and these can be just as important in terms of letting people know how uncertain you are with respect to whatever it is. And that became a really important component to doing that. It may not be the only way to present this, but I will say it was something at least that helped us in terms of at least handling that. Okay, let me go forward. And here's some questions to pose for you to think about. What is the probability there will be a severe earthquake in the Bay Area in the next 10 years? What is the uncertainty surrounding this estimate and the resulting damage? What is the probability that there will be another severe wildfire? I'm sorry to bother you with all of these negative events. That's a real problem I have, being associated with a risk center here. But this is a question I think that could be posed. And what will the resulting damage be with respect to property and the environment? And finally, what is the likelihood that global warming will increase by more than 2 degrees centigrade by 2050? And what will the impact be on wildfires and floods in California? So these are just examples of scenarios that you could actually reflect on with respect to this. And then the question is, how do we deal with them? Okay, biases in risk perception. So let's move to the perception side, which may be really going to be the theme of a lot of what I'll be talking about for the rest of the talk. And here's a question. This is my own personal thing. I always like to give an example of where I made decisions in a way that I don't think I would recommend for others to do. And this is really a true story from myself. I really only bought my first set of battery cables many years ago now, but it took my car not starting until I actually was in the position to have to buy them. And then the towing charge was a lot more than what I anticipated. And that got me. But that sets a tone, I think. That sets a tone for what I will tell you about earthquake insurance. I've already said it, but let me just say it. They purchase it after they experience a quake. When asked whether the probability of a future quake, this is the risk assessment question, was more likely than before the chances, most people respond less likely. Now put those two things on the table. They are basically saying that they were buying earthquake insurance, but they're also saying we haven't had it before, we think the probability is less likely, and now we're going to buy it. So it's hard to reconcile those if you happen to be someone concerned with rational decision-making in terms of how they perceive it. But that is what you learn. And this is one I'll put up because it isn't just the consumers, the homeowners. I was at Columbia University on sabbatical 1 week before 9/11, so I can tell you that my life changed radically during that year, and terrorism certainly became a part of our life. And we started the whole insurance decision-making process. They didn't charge, and they say this. I'm not telling you something they wouldn't agree to. If they disagree, they can tell me that in the question field afterwards. But this is what they didn't charge a penny for terrorism insurance before 9/11. They didn't have it as a separate hazard. They basically looked at it as something that could occur, but they weren't worried about that. And we were a little surprised to hear that, given the World Trade Center in 1993. That caused a lot of damage. They weren't hit that hard by that, Oklahoma City, and terrorism around the world. But here's the interesting point for what we actually got involved in. After 9/11, they refused to offer it. They could have made a lot of money. We had a meeting after 9/11, about 6 months later, where an insurance broker, remained nameless, told us that someone had purchased a coverage for $9 million of damage from a terrorism attack to one of their plants or factories, and they paid $900,000 for it. And we said, and we were somewhat taken aback as to what. And we spent about a half hour talking about why that happened. And they said, well, we didn't get any great answers, but probably the Board of Trustees or who knows what said you have to have terrorism insurance. So they didn't charge anything before and refused to after it, which, of course, led to the Terrorism Risk Insurance Act, which was a very sensible piece of legislation after the fact. And at the time, it wasn't clear how that well it would work. And now they're offering, and the government protects them against the large losses, but that's kind of what they did. So these are a few questions that one might want to think about. Now, I want to highlight, and I'll get a notion from all of you, one of the books that has influenced a lot of the work that we have been doing in this area, and we've actually worked with Daniel Kahneman and spent time with him on these issues, is the book Thinking Fast and Slow. How many people are familiar with that book? Good. Oh, great. So we have a number of you. Those of you who are not, I think you'll find it a really interesting book. It is really a book that, it takes some concentration. Of course, there's no mathematics in there, but you have to read it carefully. But here's what Kahneman does in this book. And it isn't, and he simplifies things to give you a feeling for how the world operates. And this is based on a lot of research that has been done in psychology over the years. He talks about the fact there are two systems, and again, people have used that term before he wrote it, intuitive thinking and deliberative thinking. And intuitive thinking is what he calls system one. And it operates automatically, quickly, little and no effort. Most of our decisions are made with intuitive thinking. But the challenge really is, what do we do in our intuitive thinking? We use simple associations. Our emotions play a key role. We highlight recent past experience, as I've already illustrated, and there are a set of biases and systematic biases and heuristics that people utilize for dealing with this issue. Now, here's the point that Kahneman makes, and I want to make very explicitly. For most of the decisions that we make every day, we do really well We have a lot of experience. We know when to cross the street. We know when to brake. We know when to do many, many things. Firms know what to do because they've had a lot of experience on production and other aspects. And so we are really do a very, very good job with our intuitive system. What we have said, and I'll say this for myself, but I think Kahneman would agree with this, is with low probability, high consequence events, we do horribly. We don't do a good job. We don't have the past experience because they're by definition, they're low probability. And we are influenced by our emotions, by a lot, and past experience, and all the things that are going on. So the real challenge is how do we move to System 2, which is exactly what you're learning here at Stanford and other universities, and what I try to teach in my own courses, the use of decision analysis, expected utility, the number of theories, cost-benefit analysis, that people undertake systematic analyses, look at interdependencies and interconnectedness, and most important, focus on long-term strategies. And we have a really hard time doing that because of the fact that we are moving in with respect to the System 1. So it's these issues of 1 and 2 that I want to talk about, and that's really been the theme of a lot of what you'll hear right now from going on. So let me talk first about intuitive thinking and give you a set of biases which are discussed in more detail with my colleague, Bob Meyer, the co-director of the center, who really had wonderful stories that highlight this. It's a short book that we wrote, so hopefully you'll be able to at least look at it. But in any case, here are the things that we talk about. Myopia, probably the most important in terms of everything we're talking about. We focus on short-term horizons and comparing upfront costs of protection. And I'll get back to that in a moment with the expected benefits from loss reduction. So if you're going to make your house, and I'll be focusing primarily on individuals here, but you can think about communities, on infrastructure, you can think about a lot of things, but I'll focus, for the example, on a homeowner who have to say, look, the upfront cost, it's too high relative to what I'm going to get back. And there may be some rational reasons, but most of it relates to the myopia problem. Second, as I already talked about, amnesia. We forget the lessons of the past, and we decide not to undertake protective measures. Optimism. I have a black swan here, a black swan in the Taleb sense. We underestimate the likelihood of extreme events. They are below our threshold level of concern. We don't want to pay any attention to those because why worry about them? We got about 3,000 other things we'd rather worry about, and so therefore we take that off our agenda. Those are 3. Here are 3 others that we talk about. Inertia, the status quo. We like where we are. We like to stay. It's really hard to change, and part of it relates to things. I'm not going to get into the scientific aspects, but Kahneman and Tversky talk about loss aversion. Losses are viewed much more painfully than our gains, and so we like to stay where we are, and the uncertainty also compounds it. Simplification. We attend to only a few of the factors. The point I'll highlight in a moment with examples is before a disaster, we focus on the low probability. It's not going to happen to me. After a disaster, we focus on the consequences. It has happened to me. I better pay attention. That's not exactly the way we would recommend for System 2 behavior. Try to put these 2 things together. And finally, the ones that we often are like, we look at our neighbors, we see what they're doing, we say, let's follow our neighbor. They're doing an interesting thing. They don't know anything more than we do, and so if they're not going to be doing it, we don't want to do it, and so the herding behavior leads to some real challenges. So these are biases. Let me say the highlight of the point that Bob Meyer and I made when we put this book together, where we debated this over a few years. Our point here is we're not going to change people. These are their biases. They are going to live with them. We behave this way. As you know, I behave that way, and I can give you a number of other examples, and you probably can think of some yourself in what you do. We would say take advantage of the biases or utilize the biases and try to develop strategies that actually can utilize them in a way that people will pay attention. So that's the theme of the book, really, is a behavioral risk order to follow. So let me give you a little example, and then we'll move to the ways we can deal with it. So this is a legitimate name. I looked in the telephone book. There is a few families called False, but I couldn't resist it, as those of you who know me. I had to get a name here. So this is the False family, and they reside in Palo Alto, of course. and is considering whether to invest $1,500 on that house so it is less susceptible to earthquake damage. And we can think about even more money, and I'll talk, and I know a number of people here, and we've talked a little bit about that this morning, working on making a crippling wall, bracing that. That might cost a little bit more. I'll focus on $1,500, a small amount. The seismologists have estimated a 1 in 100 chance that there's going to be a quake affecting their home, and the investment will save them $27,500. So I'm going to put insurance on the table for a moment in a very simple way by saying, that there's a 1 in 100 chance that this is going to occur. A company that is going to be having premiums based on risk, no loading costs for the simple example, would say, look, if you do this, we'll say your premium reduction will be $275, 1 in 100 times $27,500 if you take this investment. Just to highlight the trade-off between doing this and actually getting something back by doing it in order to be able to reduce the risk. And an insurer, if they had premiums reflecting risk, would actually give you that reduction. They give you a bit more if they had loading costs, but in any case, that's what I'll use. Now, the responses by the fault family, just to highlight the false family, I don't want to say fault, false family, is myopia. They fail to consider the long-term benefits of earthquake protection, so they're not going to pay the $1,500. I'm only going to get $275 back each year, so if I have a short time horizon, this is going to cost me a lot more than anything I'm going to get back, and so I'm not going to do this. Amnesia, the damage from previous earthquakes has faded from my memory, or from their memory. Optimism. Oh, a 1 in 100. God, such a small probability, I'm not going to worry about it. It's below my threshold level of concern. Inertia, why should I change my current behavior? I'm not concerned with future damage. If I'm not concerned with future damage, then, maintain the status quo. All these things come together, by the way. You can't look at one without looking at some of the others. Simplification. No attention paid to damage from a quake because the likelihood is so low. And hurting, no other property in the area has done it. Why should I do it if no one else has done it? So there, again, just to illustrate how they play a role. Now, let's turn now to how do we deal with this. This is a way to deal with it, the behavioralist audit. So what we do, and what I want to propose here is, let's take a look at each of these biases, and then let's ask ourselves what could be done to somehow address them in a way that people would pay attention. So, myopia. If we can take that $1,500 and spread it over 20 years and tie it to a mortgage and have it as a loan and give them an insurance premium reduction, maybe they'll actually want to do it for financial reasons. There may be other reasons they won't want to do it, but financially, this may be attractive next year. I'll come back to that in a moment. Amnesia, and this is something we've been working on with regular insurance. No success in implementing it, but we'd like to put it on the table. A multi-year quake insurance contract so property owners don't cancel their policy if they have no claim. It could be a 3-year policy, a 5-year policy, but focus on multi-year. Optimism, I will talk about that. Instead of telling people there's a 1 in 100 chance of a flood or an earthquake or some hazard occurring next year, why not tell them that over a 25-year period, there's a 1 in 5 chance? Maybe people will pay attention when they look at the number 1 in 5. And they do, as we've done experiments on this. Same probability if it turns out that they're independent from year to year, but 1 in 4 stands, or 1 in 5 it should be, for at least one quake in 25 years. Okay. Inertia. Add quake coverage to a homeowner's policy and then give people an option to opt out of the policy rather than asking if they want to buy it. A very simple, and there's a lot of work on default options. Simplification. Give people a scenario on the focus on the consequences of a flood rather than on its probability. So you let people know what could happen if they're not protected. And finally, hurting, and this is something we had a nice discussion with the doctoral students today and postdocs. Think about seals of approval that people have if they've done some good things, with certified inspections on well-designed property so you can create a social norm that people will say, not only a social norm, but they say my property value might not be as high as the one next door if they have a seal of approval and I don't, so maybe we'll actually try to go. So these are some thoughts that we have, and that we're trying to do experiments on that, both in the lab and in the field on that, and I'll say a word about that right now. So here's the first one on myopia. This is the false family. $1,500 to quake-proof their house. 1 in 100 chance, they get 100, I'm just repeating what I told you. I'm going to discount this by a fairly high discount rate, which will make the measure, will make the return even smaller than if it was a lower discount rate, so that over here, we can look at this. And let me see if I can show you what happened. First year, $275 or a little less, and over time, they are actually getting more than the upfront cost. In fact, the benefit-cost ratio over 30 years with a 10% discount rate is considerably greater than 1, and if the discount rate was lower, it would be even higher than that. So I've been quite conservative here in showing you this data. But it took them 8 years, notice. Short time horizons are not going to work well at all, because on a short time horizon, they're going to say, look, I'm only getting $500 back. I'm getting much less than the cost. I'm not going to do this. And what we have to do is do the following. I'll go through this very quickly. Give me a 20-year loan. I'll take a 10% loan because I use a 10% discount rate. So a 10% interest rate, $145 per year for that loan. The savings is $275. Theoretically, I hadn't said practically, but theoretically, everyone should say this is a good deal. I'm saving, I have the insurance, and particularly if you're required to buy insurance. But if you don't, then of course this whole example is out the window. But if you have insurance and you want insurance, $275 is a lot greater than $145. You save $130 every year, so why not take advantage? So that's one example of loans, how they can play a role. Stretching the time horizon. Let me just show you an experiment we just did with Shireen Chowdhury took the lead on that. She was a postdoc at our center. She's now teaching at the University of Chicago. But last year we did this experiment with respect to what happens if we gave people a 1-year horizon and what percentage of people actually bought insurance on this particular thing. I won't go through the details. I'll just show you a very highly significant difference in terms of statistical significance. It went up from 65% to 80% on this very simple experiment with respect to how one dealt with it on the basis of that. And we have a paper that we're finishing up now that hopefully will be finished, we hope, in the next few weeks. Okay, so that's an example of that. Okay, risk management strategy. So that following essentially this behavioral risk audit, how we actually deal with that. So this, my colleague, executive director of the Risk Center, we've been working with a number of companies and have tried to put a very simple framework together for risk management in terms of dealing with this. And I just want to, without getting into a lot of detail, highlight the fact that there are things that the private sector can do on catastrophic risk management, and there are things that the public sector can do. And the private sector, as you can see, can provide risk information, premium credits that we just talked about for mitigation. There is a whole issue of the bank requiring coverage on loans, which they do today, on homeowners insurance. We would love to see the requirements, I'll speak in this room, on earthquake insurance be required. That's been talked about for many years, and that hasn't happened. But it would be nice if people had that, and premiums reflecting risk to do that. And what we also talk about is, what's the role of the consumer? They have a deductible. They have to deal with the first part of the loss. A private insurance policy could come in here. Reinsurance and securitization can come in above that, and then a government backstop for the very large losses that the insurers and reinsurers feel they can't handle, which is kind of what TRIA does, the terrorism risk insurance, and there are a lot of proposals along those lines. But we also say there is really a role for the public sector, and I know there's a lot of thought here, and certainly where we are on these things. One is, and I'll talk more about that in a minute, What about the low-income people who can't afford the insurance, who can't do that? We need to have some kind of a program, and we have proposed, Carolyn and I, that means-tested assistance for dealing with that, and I'll highlight that in a moment. Building codes, of course, land use regulations, things that come up that are part of the National Flood Insurance Program, could be dealt with on earthquakes just as easily and others, and also the funding for risk reduction, low-interest loans or grants to help people. So you need the public sector involved. And I didn't put down here other things we've been looking at, which is multi-hazard insurance, so you bring a number of hazards together, but this is the basic idea. So what you have here is you have a series of layers. First layer is the property owner or the commercial enterprise is responsible for the deductible. The second layer is private insurance with premiums reflecting risk. The third layer is covered through private reinsurance or other forms of risk transfer, and the fourth layer is covering by the public sector. So this is a framework we're hoping at least we can get some traction in terms of the role of the government and the role of the private sector for dealing with that. Now, let me say a little bit more about a few of these elements. The government can play a role, as they are in California now with the California Earthquake Authority, with the state pool or the state insurer covering earthquake and wind losses. The federal government has covered catastrophic related losses, and there's a national flood insurance program that is doing a lot of that. It doesn't mean the private sector can't be involved. They are involved here in California with earthquake insurance. Several companies do provide it. And we have a number of private insurers that are providing flood insurance, and I'll talk about that in just a moment. And then a federal auction or some other ways to possibly deal with catastrophic reinsurance contracts that could be done. So there are ways that the government can be dealing with that. The well-enforced regulation. The one example I'd like to use here is related really to hurricanes. Florida had the worst building codes in the country before Hurricane Andrew that occurred in 1992. 1/3 of the losses could have been actually saved if the building codes had been enforced. Not only did they have poor building codes, but they weren't well enforced. And Hurricane Andrew occurred. What happened basically was that Florida decided they'd better really change their codes and enforce them, and they have the best building codes in the country now with respect to hurricanes than any state in the country. And so that's one, but it took Hurricane Andrew. That's the point, really. It took a disaster for them to actually deal with it. You don't have many of them, but when you have them, you're going to learn from them, and that is something I think to recognize. The thing that I am most interested in is what I learned this from the president of Chile, Michelle Bachelet. I was in Davos in the World Economic Forum. We were talking about essentially working through how you're going to be dealing with earthquake damage in Chile. And so she said, well, look, we deal with it pretty well. And I said, what do you do? She said, well, we had a challenge that a number of people in the opposing party were not quite sure exactly how we were going to deal with the building code problem. So we proposed the following that we've now implemented. We basically have any developer who has not met the building code over the 10 years after the structure is built is liable, and they are sent to prison. And there were several people who have been sent to prison. Now, I asked the question of all of you, could we do this here in this country? I'm not sure, but I thought it was absolutely the best way to enforce a building code is to make it pretty costly if it turns out you're not enforcing it. So that's what they do in Chile. Third-party inspections could be dealt with, and then seals of approval for well-designed structures, as I talked about, would be a helpful way on the regulations. How do we deal with affordability? Well, we deal with affordability, a proposal for affordability, and we were very concerned about this after Hurricane Sandy, certainly, and even before that time. And Carolyn and I went and looked at some data, which I'm not going to talk about here, in Ocean City, New Jersey, which was hit very badly by that. And we realized there were lots of low-income people there, and we said, why don't we at least think about a way to help these people, but also to get support from both the Republicans and the Democrats in doing it. So here's what at least a suggestion. You have some kind of means-tested voucher or tax credits for requiring financial assistance to purchase insurance. So a low-income or even middle-income people might get something to help them along if they fell below some level based upon some means test. But here's the kicker in terms of what we would say. If you're going to give them a particular tax credit, they got to do something. They got to mitigate their house if there are cost-effective mitigation measures. They got to reduce the losses. Two things happen if they do that, and you give them a long-term loan to help them out. One thing happens is they're now able to afford insurance because the premium is going to go down considerably if they do a mitigation measure, so the federal government or the public sector will have to pay a lot less, and their house is going to be made a lot safer. So that was kind of a pro. We spent a fair amount of time talking with a number of agencies on that, and it's on the table, but nothing has happened yet, and the flood insurance program gets renewed for 3 months and gets renewed again for 3 months and 3 months, and maybe something will come about as a result of that. Okay. Let me end. I want to tell you about one other thing that I don't have here as a slide, but I want to just mention it to you. We are doing a whole set of experiments on flood insurance because a private insurer, the largest private insurer, Evan Hecht, who is now with Amwins, has given the center some money through Amwins and his own funds, but primarily then they're a brokerage organization to do experiments. And here's an experiment that we did that relates to the default option, inertia. He had a very creative plan. He basically, that we resonated to, certainly my colleagues and I. And that was, I sell you a private flood insurance policy, and I'll give you $35 if you have a flood, and you then will get $10,000 back to invest in mitigation measures to make your house safer. And these would be measures that we can sort of say would be appropriate measures. And I thought that was a terrific idea. I said, this is great. It's only $35. You get $10,000 back. I would think that people would buy it. He said, no, for whatever reason, we don't have a lot of interest in this policy because we've had maybe 4 or 5%. So we ran an experiment with him over the summer, this past summer, and we're writing it up right now. And we basically said, look, why don't we tell people, and he did tell people specifically, you can buy a flood insurance policy with this flood ready, that's what he called the policy, on top of it, and if you don't like it, you'll get $35 back. Up to 40% interest on that policy. Just changing it from opting in to opting out, people said their interest. Now, it's not clear how many are exactly going to buy it, but the interest was a major difference. So we are thinking about those kinds of issues with respect to this. Okay, that's kind of where we are. Now, what we are trying to do, and I mentioned this at the beginning, and Carolyn Kuski, my executive director, is primarily responsible for pushing this idea, which we're now looking at. And we're looking at a policy incubator, which is an idea of working with all the stakeholders. We think that's absolutely critical, to work with all the stakeholders, not just a couple, real estate people, banking. We need all the help we can get from all of you in terms of dealing with the earthquake problem on that side, to develop ideas, encourage innovative thinking, and advancement of on-the-ground solutions. So the idea is really to think about like a business incubator, a policy incubator. The idea is something along these lines. You have an idea, you get some data analysis, you bring people together, you bridge them, you do some stress testing, the kinds of things we like to do. And that's what we're really working on, and we're working on that in terms of trying to get people to pay attention. Okay, challenges and questions. Let me conclude with a few of these ideas. How can I do want to say this, you've already heard from me, how can the impacts of climate change be incorporated in changing insurance policies to encourage investments in cost-effective measures? Less so for earthquake, certainly, but certainly for wildfire, certainly for floods, certainly for hurricanes with climate change, and who knows, the earthquake may come under that as well. How do we better communicate the risks of wildfire and earthquakes and develop economic incentives to encourage investment protection before the next disaster? Let me say right at the outset, we can only go so far by having the behavioral risk audit. People will pay attention. That they do. Will they actually take action? Our feeling is very simple. You're never going to, very straightforward. It's going to be really hard for people to take action unless you have short-term incentives so that you deal with the myopia problem, because they're always going to find a reason why they don't want to do it. So get people to pay attention with the audit, get economic incentives like long-term loans are an example of that. Combine them. Make them think that they're going to benefit next year, including sleeping better at night. There's nothing wrong with that. If that's what's going to do it, because you tell them what a worst-case scenario is, bring that in. Why not do that? And finally, how do we deal with the affordability issue for low- and middle-income families residing in high-risk areas? Basic conclusions, we're in a new era of catastrophes. There are more black swans. We need key stakeholders to agree on the importance of investing in insurance, cost-effective loss reduction measures, and lots of other regulations and standards, acting now rather than assuming it will not happen to me. And the behavioral risk audit, in our feeling as a policy incubator, are attempts, and I will only say it as attempts, to encourage deliberative thinking and provide short-term incentives and convene stakeholders to address this critically important issue. And I will end, you all have a copy of this, so I have to ask you the following question. This was a title that we would never have thought of unless we got some information from some colleague, and a colleague gave us. Why did we call it? I'm going to start the question session, and then I'm going to turn this over to Jack. But someone, why did we call it the ostrich paradox? Anyone want to, those of you who know the answer, please, man, why did we call it? You know the answer? No. If you don't know what you need, tell me. Yes. Because I think the book does tell you. that the book does tell you. But those of you who have not read the book, if anyone wants to volunteer, yes, sir. Well, it's a very interesting thing, and that's exactly what I thought until my colleague, one of my colleagues actually told me, look, you don't know about ostriches, and we didn't. Ostriches do not stick their heads in the sand. They put their beaks in the sand to get food. They are extremely smart. They are very fast because they can't fly. They protect their young. They do all the right things. We are the ones who put our heads in the sand. That's why it's called the ostrich paradox. I will end on that note and turn this over to Jack. Thank you very much.
Thank you, Howard, for a very interesting talk. So we have some time here to take some questions. One logistical note, so we have some microphones just to make sure that the full audience can hear your question.
And I would appreciate, if I could, if people would introduce themselves and say who they are, so I get to know what
sounds good
before they respond.
So to help with inertia, to follow some of your thinking, I think you can get a microphone delivered to you if you get a hand up in the air. But yeah, please introduce yourself as well.
All right. Thank you so much. That was a really interesting talk. My name's Daniel Green. I'm a postdoc here at the Center for International Security and Cooperation, and I'm interested in mitigating catastrophic biological risks that come from biology laboratories that are not maintaining appropriate safety and security standards. So they might be working with some pathogens or doing synthetic biology research that could be misused accidentally or deliberately. And my question for you is around a type of bias that I don't see reflected in the 6 categories that you mentioned, and I might call it something like a self-serving bias. So in this case with biological risk, I think it's very important that these biologists prepare for disasters, but they are also the ones who are, in some sense, contributing to the risk of the disasters. So unlike an earthquake or a hurricane, their actions could potentially manifest a disaster. And a lot of biologists are reluctant to engage with that idea because it's threatening to their idea of themselves as doing good work. So I'm curious if you have any thoughts about how to engage with people around risk when their own actions contribute to that risk.
No, it's an excellent question, and you're absolutely right. I talked more about things that were acts of God, as they say, or things that were outside of that, although there are lots of people who think that climate change would fit into that category as well. But let me say, the one possible way to address a problem like that is what I talked about with the developer in Chile with respect to the building code thing, is to say, look, you are responsible for essentially creating this particular hazard by developing a structure that is, and we're going to let you know that you are going to be responsible for this. I'm not saying you would have to send someone to prison, but you would have to say something about the fact they would be fined or that they would be called attention, and they have a reputation at stake, and you would have some media coverage of the fact that they hadn't done that. Anyone who's read Bad Blood knows essentially what the challenges are with respect to things that were done that would actually, and I read that book, and I must tell you, it's a book I highly recommend if you want to understand exactly the kind of thing that you're talking about. And it's extraordinarily hard to do that, but at the same time, given the way you're describing it, I would think that something like that might be a starting point with respect to dealing with it, is highlight the notion of responsibility and highlight the notion of being responsible in a very formal way by saying something will happen to you if it turns out that something goes wrong. So. And Anne, please introduce yourself for those who don't know you. I do know.
For those who don't know me, I'm Anne Kirmijan, faculty here. Very interesting talk. Thank you very much. This is more of a comment than a question. You mentioned that the CEA right now is purchased by barely 13% of population in California.
That was the latest data I got from Google before I prepared my talk. I want you to know. It may not be the most accurate, but it was the most.
I think it's close enough. And that's not my question.
Okay, really. Good. I'm glad.
My comment is, my interpretation, or one of the reasons why I believe people don't purchase the CEA, the California, the insurance through CEA, is because the deductible is very high, combined with the very high value of properties. An average home in Palo Alto is $2 million, let's say. So if I have 15% deductible, the deductible amount is $300,000 in case of an earthquake. I have to have a lot of damage to get anything out of the CEA. I have to have damage that's more than $300,000 to get any from the CEA. So I believe a lot of people are not purchasing the insurance through CEA because they don't believe they will have that much damage that will make it worthwhile for them to purchase it. Now, one thing I believe that we have done is we purchased insurance through it.
You personally have done?
Yes, I personally. We purchased it through an outside insurance, through another insurance company, and until recently, no insurance companies were providing earthquake insurance, but in the last decade or so, there are private insurance companies that are providing earthquake insurance. So one thing that we did is we tried to estimate how much damage we might have, and then we got coverage that is large enough that will still give us some money over and above the 15% deductible. So I don't remember exactly how much the coverage is right now off the top of my head. I'll have to go back and look at the insurance policy. But essentially, if I have $100,000 worth of actual damage, I expect to get at least $40,000 out of that damage, as an example.
So what you're saying is that the deductible would be based upon the coverage that you have.
Correct.
You would not get you would not have $2 million. You would have a smaller amount, and as a result, you'd have a smaller deductible, and you would come out ahead as a result.
Exactly.
Well, I think this is an interesting area. I'm not sure we can get into details. I know we have people at the CEA who are here who may want to say something, but I did hear that from many people, what you've said. And what was interesting about that was that they were saying, look, I'm going to take the money and I'll mitigate my house and I'll do other things that I would have otherwise done with insurance. So they saw it as a pot, a Melton accounting kind of thing where they put it in a pot to deal with the risk, but they said, I'd rather do it with mitigation. But one thing I will say, and if either of you, Danny or Janelle want to comment from the CEA, you have lowered the deductible down from, people can lower a deductible if I'm not sure.
5% up to 25%.
So there is an opportunity to have a lower deductible, but that one solution is your solution of dealing with that. Okay, I think there was someone here. and introduce yourself.
Thank you so much, Professor Kunreuther. Your work is really seminal and has defined the careers for many of us, including myself. My name is Kate Stillwell, and I am a very proud alumni of the Stanford program here in civil environmental engineering.
Right.
And I think that a lot of the folks here in the audience are, if not students, alumni of that program. And you know, one of the common misconceptions among structural engineers and folks like myself is that why isn't earthquake insurance mandatory in California? If it was mandatory, then the collective prices would all go down, wouldn't they?
Well,
and I want to hear, and I want it to be explained to this audience from an economist, whether that common perception is a myth or a reality.
Well, I mean, I'll say something about, we've spent a long time trying to figure out why banks weren't requiring it, which is the first thing that we thought about, like they require homeowners insurance. And the answers that we would get is, look, if we require it, they're going to go someplace else for their mortgage because they don't want it. And so therefore you have a real challenge with respect to getting the banks to do it as they normally do with homeowners. Then the question was, and I can only give you one example. There was a person we worked with a number of years ago from Freddie Mac, one of the agencies, Al LeQuant, who had actually developed and proposed that they require this thing on co-ops and on large buildings, et cetera. And I remember him, because I talked to him a little bit about that. That was the first step in kind of what you were doing. And that got nixed by the state legislature. There were all sorts of pressures on not doing it. That's what I had heard. So if anyone wants to comment on that, Haresh, do you want to make a comment on that? You may very well, or if anyone else wants to comment on that. I mean, you have to get the stakeholders. And I'll tell you, the one group that would be highly opposed to that are the real estate community. They may be more in favor of it now, but they would really lobby against making anything. That's why you really would like to have the banks and financial institutions seeing that their risk is at stake. But if they're afraid that someone is going to go elsewhere, they're not going to require it. Do you want to make a comment, please? Yeah.
Yeah, so this is Janelle Maffei, California Earthquake Authority. And so the answer, Kate, is that when you buy an insurance policy, you bring all of your risk and you give us 1 year premium. And so we have to buy reinsurance, which is very expensive. So with the current system, you'd have to have a lot of people in the Central Valley and in areas of very low earthquake risk. Now they're going to pay less, but you'd have to have lots of them. And that's the idea with insurance, right, is you make the pool big enough that everybody is going to pay for a risk that happens to a small subsection. So the reality is that if everybody bought insurance in California tomorrow, no, the current model does not work. The prices would go up because you have to pay for reinsurance, and there's no federal or state backstop.
Okay, well, that's an interesting challenge, but it doesn't. The requirement as a separate kind of thing was something that has been very hard to get the state. I mean, to require earthquake insurance, which I think was your question, Kate.
Right.
Forgetting about whether the premium will go up or down, but that may be one of the reasons why they didn't.
So the difference between flood insurance and earthquake insurance is flood insurance, right, is mandatory in areas of the 100-year floodplain, but it's not actuarially sound. And when the Congress passed a law to make it actuarially sound, they immediately passed a law that said, whoops, because nobody could afford it. So, there has to be some way to mitigate risk so that you can afford insurance, and then make the risk pool large enough that, once again, that it's affordable.
And have the government, if you can't make it large enough, at least some backup. Like if they really move to earthquake insurance with the private sector and the CEA could play roles with private insurers on backing up and whatnot, which they do today to some extent.
Right, and so the brilliance of the CEA was they made the budget is separate from the state budget, so they can't dip into it when there's a bad year. But because we're not part of the state budget, they don't feel that there's any need to be a backstop as well. So,
Got it. Okay.
Paradoxes are huge.
I think Haresh has a comment.
Please have introduced. Oh,
Can I?
Please.
we know who you are. Haresh, you should stand up for everyone to see you. I mean, really, you've been sitting down the whole time.
I should stand up. I will. The comment of Anne was correct. I think you made it very appropriately. Kate, you also made a good comment that if everyone buys, the premium will go down. In both the comments, one thing that is missing is irrationality of human beings. Decision makers. Forget about the general human beings, but the decision makers are also equally irrational. CEA, very heavily.
California Earthquake Authority, for everyone who doesn't know what CEA stands for.
California Earthquake Authority. We work, my God, I cannot tell you how hard to develop some understanding at the governmental level of why it is important that we do this. Nevertheless, when it was created, we gave them many, many options of how to roll it out. I'm afraid to tell you that they selected the worst bottom two options to roll out, and not some of the better options that we thought they should roll out to increase the participation. But nevertheless, it happened. But I want to comment, Howard, on something that I want your opinion, and that is self-criticism. We, people who are in the research, economists like you who are in risk management, people who are in behavioral science, who understand how human beings behave, we are the worst enemies of ourselves. I'll tell you why. The global warming was known for at least 50 years now, and that man-made events is causing the global warming and all the things that will occur. It isn't until recently that people like us have started looking at wildfires. We react. We don't go back to the fundamentals and look at what could happen, and let's develop an understanding. Wildfire, I remember, Wayman would know more. He is the main maker of models. At RMS, wildfire did not come on the horizon until about 5 years ago, 7 years ago. Earthquakes. It was not until '85 that insurance companies were interested in offering earthquake insurance. I recall working with Solomon Brothers, and who was the other one? Solomon Brothers and Aetna. And we told them that we can tell you what earthquakes can do, we can give you the risk, probability, and the whole setup for developing insurance premiums. Initially, they said no. It took us years, from '84 to '87, to convince them that this is something rationally done. Imagine in this vast history of earthquakes, we did not start looking at it rationally until recently as '87. Wildfires, we have started looking now, let's say last decade. What were we waiting for? Didn't we understand that climate change means too hot, too cold, too hot, too cold, and wind? California was always like what it is, dry for 8 months. Nobody was looking at it. Suddenly now everybody wants to look at it.
Well, let me say something about that. I'll give you my view on that. I think it's a little bit more complicated than that, Haresh, as you know, but I will say it more explicitly. I think there were a lot of people who were looking at climate change earlier. They were in the wilderness in the sense that a lot of people didn't pay attention. But one of the real challenges, and IPCC was around since the 80s, as you may know, the Intergovernmental Panel on Climate Change was doing that. So there was a lot of attention that was given. And I've been reading books now, as you may have, and others, in terms of this whole issue, that it was really hard to get the attention of the stakeholders who really were going to have to sort of to push this along. And we still don't have that today, as we know. We're not going to get into that, but we still...
All reactionary.
But the point is that the people who were concerned about that were doing the things that were important, and they were spending a good portion of their time. And I don't have to go through names, but you can just look through the people, and there were a large number of people who were doing that. I think the challenge is the reason why we're trying to do the policy incubator as a part of it, because we haven't been successful ourselves in proposing policies that necessarily will get implemented, and so we're saying we're going to have to spend time. And I'd say the answer to that is we all have to spend time on trying to bring the stakeholders and the key people together to appreciate this in such a way. And the unfortunate part that you're raising, which I will highlight, which was really a theme of the talk today, is it often takes a disaster to get anyone to sort of put their things on. And there's a column that I used in my risk class when I taught my class last year in January by David Leonhardt that I recommend for anyone to read. It was the last column that he wrote in December of 2018, and he said the most important issue of 2018 was climate change. And here's what he said. He said, we're not getting anyone to pay attention to this. We've got to use floods and hurricanes and things that are happening where people will pay attention to it, even though we can't say it was caused by climate change. And that was the theme of my class, so I was very happy to start this with illustrating an article. And that was his point. And I think it's almost something that I would respond to you on. We just don't get people to pay attention until it's too late. And I think with climate change now, and look who got Time, the Greta Thunberg, who got the Time Person of the Year as a 15-year-old, who finally got everyone to pay attention in ways that were unheard of, and in terms of her ability to do that. We are trying to get people to pay attention, and I would say that is one of the most important issues that we are focusing on in our risk center now. Not that we haven't been interested. I was on IPC 4 years from 2012 to 2016, working as a chapter lead author on risk policy and uncertainty. So I got to know, and I wasn't sure why I was there, to be honest with you, because I hadn't really focused on climate change very much. So I felt all of us have been steeped in that, but now we're going to pay attention. And the hope, and I think I would say that in the context, is it isn't too late. The hope is that we're going to be able to do something on this thing before it really does create the problem. So that's my response.
Can I suggest you have something interesting going at your center called New Ideas for Risk Management. Your group is doing some work, I understand.
Thank you.
Right? I have a suggestion. A few years ago, Waymin, myself, and American Re, which was purchased by Munich Re, started a company, and the idea was to insure only the first $200,000.
Of what?
Of any property.
Of
That
any
is,
property.
if there are $2 million property, we forget about,
Kate's only going to buy 100,000.
but only insure maximum payable is 200,000, and there is a deductible of maybe 1,000.
Okay. Well,
The companies we established a company, the reinsurance company invested money and so on. Then we took a survey in Washington State and, where was it? Washington State and Oregon, of how many people would buy it.
no one.
To our shock, they said, no, we don't want to buy it. We said, usually in an earthquake, the average loss in 1906 was 8%. The average loss was 8% of the property value. In 1989, when the Loma Prieta earthquake happened, the average loss was something like 6.5%. Low. So if the house is $2 million and assume 10% average loss, it will be 200,000, right? The number you cited. We said, why don't we insure that 200,000? Its premium rate would be higher, because it's more likely to occur than not. But people will be protected because they will need 150,000, 100,000, 70,000, 80,000 to repair their house, and they will be covered. Most people, unless and until the house is not anchored, the house is not taken care of, are not going to have catastrophe loss today, in today's environment. But amazingly, when we took the survey, nobody wanted to buy it. So we shut the company down before we started business. Because people, as you put it beautifully, we are irrational.
Well, I don't know whether I want to use irrational. We have our challenges.
I think I see a student question here in the middle.
Yeah. Here's the microphone right there.
Hi, I'm J1. I'm a first-year master's student here in structural engineering. First of all, thank you for a really great talk. I enjoyed it very much. With the basic knowledge that I have of how insurance works, as I understand it, insurance is designed such that like a large group of people pay a relatively small sum of money so that in the case that a disaster strikes, the insurers can cover the losses that are suffered by a few. And I wonder if you think, I wonder what you think about whether regarding insurance from a somewhat ethical point of view, like promoting insurance as an idea of everyone kind of chipping in so that we can all help relatively few who need the help, might act as some sort of an encouragement for purchasing insurance.
Okay. Let me give you a broad answer to this rather than a specific. I think the challenge that you're raising is who should pay? Who should pay for the losses? And I'll give you two extremes in answer. When you have a market-based system, or when you have a system which is sort of saying that everyone who lives in a particular area should be responsible for their own risk, then you have a private insurance market where premiums would supposedly reflect risk, and everyone charges a premium that is basically reflecting what their risk is. And that's one way of viewing it, and that is often what insurance is doing in many, many risks. But the other extreme is the one you're talking about, which is that everyone feels that there's a social responsibility for all of us to cover the losses in a particular country. France is doing that. Other countries are doing that, where everyone will be paying a premium that is not reflecting their own risk, but is reflecting the average risk of everyone in that country. That's a way to deal with it, and they've done that with some of their natural hazard. They're dealing with that. Our position, very frankly, from the risk center point of view, and I'll give you this, is you have to put that on the table for the legislature, for society to make that decision. We can raise the question who should pay. We have recommended, as you already heard, for low-income people to get kind of subsidized on their insurance if their insurance is going to go way up if a premium reflects risk, but they have to do something in return. That's a recommendation. It isn't that we think that's right. So I don't think you can answer that question, really, until you really figure out what the society would like to have done. And we are, and here in the U.S. we have one view, and in other countries they have another. And there is no right answer to that. It's not a matter of this is the right way to do things, but this is something that everyone has to say who should pay. I mean, that's the only way I think I can answer your question.
Let's take a final question over here.
Hey, good evening. My name is Luke Beckman. I'm a Stanford grad and currently serve as the disaster director for the Red Cross for California and the West Coast. Thank you for the talk. The book is fantastic. I've read it 2 or 3 times already. I've been coordinating disaster operations around the country. I'm tired of floods, so I came out to California, and now we have a lot of fires. But floods are the most common, most costly disaster that we have in the United States. But when we look at our values as society, and it's changed sort of over the decades, but we are subsidizing a lack of preparedness. Right? So a bad thing happens, we pay a lot of money, and then that hits the taxpayers. Simple question for you in the this may be a PhD thesis, but
Simple question, but a PhD thesis. I think it's
Maybe a simple answer.
probably the PhD thesis.
what are your thoughts as it stands today on the National Flood Insurance Program?
Well, I think this is something we have spent a fair amount of time, and there is a number of articles and things that we can give you that will highlight that. But let me kind of address your question on two levels. One of the biggest challenges that we have is the point that you're raising. People tend not to link ex ante, what happens before, with ex post. Because if they can say, here's what you should do before, and if you don't do that, you're going to be paying a lot of money or you're going to be doing things ex post, that's a real failure of our being able to address that problem. I think the National Flood Insurance Program, if you would, has a lot of value in the following sense. It is geared towards making sure, in theory, and not necessarily always in practice, it has been geared towards actually having land use regulations and building codes, and it's a community-oriented program, and you can't even market flood insurance unless the community has taken actions. And if that's enforced, that's a very positive way of saying we're going to try to reduce the risk. What it has, the challenges are that it started a program by subsidizing anyone who was living in the area when it started, with the idea that that was only fair to them to keep their property values up. And the hope was that over time, there would be more and more people moving in and that there would be actuarially fair premiums for the others. And if that had happened in the way they had anticipated, there would be less of a problem than we have right now. Right now, I think the biggest challenge with the program is twofold. One is they have outdated flood maps, and they're trying to address that. They have outdated risks, and they're trying to do that with Rating 2.0, which is part of what the program is about. And all of those are moving in the right direction, but even those, Congress has postponed the ability of being able to do that for another year or so, and so they're not able to push forward. We have worked very closely, just so full disclosure, with the chief actuary at the flood insurance program, Andy Neal, who was terrific in terms of his willingness and interest in trying to move in that direction. But there are lots of impediments to going forward, and one of the big issues really is related to the low-income people. Because if you have premiums that reflect risk, you're going to have enormous challenges with respect to getting Congress and others to agree to that kind of thing unless there's something done with means assistance. And I will tell you the personal story, or our story of our risk center. There was a piece of legislation that was passed, the Biggert-Waters Act, that was passed in 2012, 3 months before Hurricane Sandy, that actually moved towards having risk-based rates, which is the first time Congress had ever done anything like that, which was something we had been working hard with a number of others to move in that direction, with the idea that affordability would be addressed with a separate study. That piece of legislation got overturned. It got overturned because there were people who were running for Congress, for the Senate and whatnot. And I won't mention names because that's not appropriate. But I will mention an acronym that really highlights the challenges we face in dealing with this problem, where you can make a set of ideas. And that acronym is NIMTOF. Anyone who doesn't, anyone want to take a guess at that? Not in my term of office, that's right. So not in my term of office. And that is a major problem. And if the flood problem could get some passage long term and can deal with these things, I think it is a superb program. We would, on some level. But what we are doing with our center to fully answer it is we're working on private insurance. We think private insurance is a very important component. So does FEMA, Federal Emergency Management Agency, is pushing for that. If you can get private insurance and the flood program doing some of the things and backing up with government backstops and dealing with affordability, that's our view on the program. Let the market go as best it can, but you have to have the public sector dealing with the very large losses that reinsurers or risk transfer instruments will not cover. You'd like to do as much as you can on that level, and you have to deal with the affordability. And I want to change the word affordability. No one seems to like the word affordability in Congress. They feel that that's not a good word to use for whatever reason, including the Affordable Care Act has not been used. So I'd like to change that word, and there's discussions with several people who have indicated that to me. And we need fairness And if we have fairness, maybe people will pay attention. Affordability may not be the way to deal with it. I'll turn this over to you.
So it's clear we could talk about these interesting implications and decision support for the rest of the evening. Unfortunately, we're coming to the end of our time here. But I think reflecting on the talk and your work more broadly, the structure that you put to some of these confusing problems and bringing some kind of understanding to them, and this idea of kind of why we underprepare for disasters, it's reassuring to think about, there is some explanation for things that sometimes seem confusing. It's also clear we have many years of work ahead of us to actually continue solving these problems, but I think you've provided a lot of informative and inspiring ways to think about moving forward with those things. So thank you very much for a great talk.
Chinese say thank you.